Welcome to Project Frame's June community meeting. My name is Carrie Browder, and I'm the Director of Impact Accountability at Prime Coalition, as well as the Director of Project Frame. We're joined today by some wonderful speakers who will talk to us about their methodology and best practices for implementing GHG impact when screening venture investments. And just as a reminder, please hold your questions until the end of each segment. You can put some in the chat and then we'll try to get to them all. And we really appreciate you all joining and are overwhelmed by the growing enthusiasm around this topic. All right, first and foremost, I just wanted to provide the welcome and a quick update to all things occurring in Project Frame these days. Then we're going to switch the order. We're actually going to hear from Clean Energy Ventures and then Energy Impact Partners. And then we'll do a quick closing. Typically, we try to make sure everyone has a little bit of found time at the end. But ultimately, if questions are going and discussion is good, we'll go till the end of the program. All right, so a little bit about Project Frame. As a reminder, it is a nonprofit program convened by Prime Coalition, and that we are focused on demystifying GHG impact measurement and management, and building best practices around standards and methodologies to reinforce transparency and collaboration. Right now, when we looked back in December, we have about 600 individual members representing 370 organizations, the majority of which distinguish themselves as venture capital or private equity, with 200 billion in assets under management and 60 billion in capital raised intended for climate. We are in the process of updating this information this month. We do it biannually. We broke the 800 mark in members just the other day, so that's really exciting. Our objectives for this year are to complete our new content work plan, which was started by our content working group. We will continue to improve and increase our database of investor profiles, 2 of which we'll be covering today. We plan on engaging in markets outside of the US and Europe, since that is the primary areas where we are seeing the most excitement, but we hope to spread this information and engage voices in other markets as well. We are in the process of developing a tool platform based on the work of the Data and Tools Working Group, which is separate from the Content Working Group, and that we plan on engaging a bit more deliberately with global players that are doing complementary work. All right, general updates from Frame. If you haven't seen it already, this is your moment. We released our pre-investment methodology deep dive in April. This was a compilation of years of work of different contributors to the Project Frame community focused on forward-looking emissions impact. We really want to distinguish this practice from footprinting. Our primary focus is on how can we establish common terminology, best practices, and methodology for vetting solutions prior to investment, understanding that we hope to have an outsized impact on climate change mitigation. And we have some stats here. We'll share the link in the chat if you haven't accessed it already, but we are very proud of the work that our authors and contributors were able to provide and build and give value to the community in this emerging space. So far, we've had about a little over 3,000 page views and 406 downloads of the report. We developed 12 new glossary terms that those who have been a part of Project Frame have agreed to sort of adopt when we're talking about forward-looking emissions impact. And there's a list of some of the groups that have covered the release. Next, we piloted a small group discussion on compensation and impact. Even though our focus is best practices and methodology for forward-looking emissions, we have found that many in our community would like to talk about topics outside of that purview. So we raised the idea to the group here on one of these phone calls back in November or December, and then we're able to convene a small group. We capped it at about 10 investors who were interested in thinking through the pros and cons and best practices of tying compensation to impact. Even though that it was a closed door discussion, Chatham House rules, we did agree on some key takeaways that high level I'm sharing here, but there's a little bit more depth in the synthesis that we're holding on the Project Frame website. So you can find out more about that. And since then, a group called The Impact, in partnership with Tipping Point Fund and Oxford University, have decided they're going to do an additional research project around this concept and are looking for investors who are implementing these schemes to assist with their research. So if you're interested in being interviewed, you can let us know, and we will be happy to make an introduction if you would like to be part of the research. All right, we have a new content working group that we just launched. We have grown by 3 times. The last content working group was quite a bit smaller. We're really excited to have so many organizations supporting our work, and we have a 14-month work plan. The point of this group is to diversify the type of content that we're producing for our community while continuing the efforts around honing and refining the pre-investment methodology. So our intention is to provide more case studies that show how the methodology could be implemented, a question board where people can have open discussion and trade information and thoughts around forward-looking impact assessment. We hope to develop a methodology one-on-one course for those who are newer to these concepts. And in time, we also want to break more into post-investment impact monitoring and management. If you're interested in joining the content working group, unfortunately, it is closed for now. However, there are still ways to engage in the content and provide your feedback on the methodology before it is released publicly. And we do that through focus groups. So anytime we come to a topic where we really have trouble reaching consensus, we come up with a couple of different options and open it up to a larger focus group of investors and experts to basically help us decide what we should say is the best practice for now moving forward based on the state of play. And so we did this a couple of times, and you can read about that in our last methodology deep dive report, which we shared. But if you would like to be part of a future focus group and join the list, please send us an email and we will be in touch the next time one of those comes about. All right, a little update on the data and tools working group. We completed our first tool showcase this past year. We launched the data and tools working group in September. About 20 organizations participated, and we decided we wanted to look at the landscape of available software platform tools that could help investors or ventures assess forward-looking impact. We came up with a methodology to do the evaluation and solicited an open call to developers who wanted to participate. We ended up selecting 6 that we felt met our criteria that are listed here, and we're able to get 20 different tool reviewers to participate. We're working on the synthesis in partnership with World Fund, and we plan to release the synthesis at some point in July. In addition, during this process, we found out that there are a lot of really interesting tools that might not have met our exact criteria, but could be really relevant to the field. So we are continuing to collect information on different tools, organizations, third-party verifiers, and even data sets that we think could assist with forward-looking emissions impact calculations. If one, we will put a link in the chat for you to share it. We'd like to create some sort of platform that makes all of these different resources accessible to our community, and that will be part of our continued work plan this year. All right, a little update on what's coming soon. We are officially launching a Project Frame LinkedIn page. We launched it yesterday. And then in the next few days or in the next week, we'll also launch a group that will just be for Project Frame members. As we mentioned, we would like to have a space where people can just trade ideas. And so the group will be open for discussion within those who are part of Project Frame. And then the LinkedIn page is actually where we will share whatever we have come to terms upon as best practices, new glossary terms, things that are formally from Project Frame, whereas the group will be informal, but hopefully a great resource to connect with others in your community who are grappling with these issues. We will also be doing a series on contributor Q&As from those who have contributed to the pre-investment methodology that we released in April. So keep an eye out for those. A lot of really interesting feedback from our different authors and experts. And then the tool showcase synthesis that I mentioned that we hope to have released in July. All right, I am going to stop sharing my screen for a it's just a second to see if there are any questions that I can answer. 1 second, I'm looking in the chat. All right, it looks like we are good. So we are going to dive into our investor profiles. Our investor profiles are probably our most popular format for continued engagement. These meetings have grown exponentially over the past year, and we're excited about all the positive feedback we're receiving. Things that we've learned is that there's no one size fits all for any office or firm, that some investors use the profiles as opportunities for self-reflection, meaning not all investors who sign up for an investor profile are ready to share it with the broader community, but still find the process of going through a profile really useful for their impact practice. And that we would like to have more profiles in order to make relevant comparisons and see trends and gaps in the market. What you'll be seeing here today is the first iteration of our investor profile 2.0, we call it. We've slightly updated the questionnaire and the format based on feedback we received the last year. Recordings are absolutely optional. And then we have bi-monthly presentations like the one you're participating in today. We hope it will continue to be a positive force for collaboration and sharing in the future. Right now, I'm actually going to transition. We're going to do EIP first. So 1 second, and then I'll come back, or sorry, Clean Energy Ventures first. I'd like to first introduce Yijing Chao, who is the investment principal at Clean Energy Ventures. She was at Future Energy Ventures previously and has a strong background in working with startups in the energy space. And I'm not sure if Dave was able to join. He is at a conference, but she will also be joined by her coworker, co-founder and manager of Clean Energy Ventures, David Miller. So I will stop sharing my screen and send it over to you, Yijing.
Great. Hi, everyone. Nice to meet you all. And we're thrilled to be presenting our investor profile today. Dave should also be on the call here presenting on behalf of Clean Energy Ventures, but certainly want to highlight that it's really the work that Dave and Shambor have been working on over the past several years that really goes into the investor profile that we'll speak through today. Shambor is unfortunately at a conference today, so wasn't able to join, but it's really his work as well that's being reflected here. Perfect. So for Clean Energy Ventures, we'll run through with an initial overview of the fund. In terms of an agenda, we will cover just a high-level overview of Clean Energy Ventures as an entity, our impact goals and process, the way we pre-screen investments and how we progress them to diligence, our portfolio stewardship. We'll run through a quick case study of one of our recent investments and share some lessons learned. So Clean Energy Ventures is an early stage climate-focused venture fund. We make early stage climate investments in the venture capital space. And for us, this is seed to Series A investments in early stage technologies that we think have the ability to have a significant impact on climate mitigation. Within the sectors that we focus on, these are your fairly standard, I would say, climate tech investment opportunities. So investing significantly in the energy sector, in transportation, in industrial processes and decarbonizing industry, in carbon to value technologies, and also in the water sector. And the case study that I'll present later is around the carbon to value chain. We invest in companies in North America, in Europe, and in Israel. And there are 14 team members on our investment team. 3 of those are focused on greenhouse gas assessments. So that's Shambor, Dave, and I. However, I would say that the responsibilities of greenhouse gas assessment really falls across the entire team. As I'll go through in more detail later, you'll see that it's really very much part and parcel of our investment evaluation. And therefore, it's not something that just Dave, Shambor, and I work on, but really something that all team members think about and utilize in their diligence process. Fund 1 for Clean Ventures was a $110 million fund, and 100% of the assets evaluated under Fund 1 and going forward will be assessed for greenhouse gas mitigation impact and the ability to reduce carbon emissions or greenhouse gas emissions. In terms of our impact goal and processes, our goal is to invest in early stage technology companies, which we believe have the potential to avoid, reduce, or remove at least 2.5 gigatons of CO2 equivalent greenhouse gas emissions between now and 2050. It's a cumulative target. So we look at the expected emissions reductions between now and 2050 and summate the emissions reductions for each year. And it's quite a sizable target. It certainly means that we're aspirational in the types of companies that we look at, invariably investing in hard tech or hardware enabled technologies that really enable a significant impact on greenhouse gas mitigation and climate mitigation. As I mentioned already, we invest early in a company's journey, typically at seed and Series A, almost always as one of the first institutional investors. And we think this is an important role to play in terms of being able to catalyze future investments from other institutional investors that typically invest after us or alongside us. And we almost always lead investment rounds as well, again, really taking an important position in terms of catalyzing early stage companies and early stage investments in the climate sector. Overall, we hope that the combined impact of our portfolio of companies will have a significant impact on climate change mitigation, and looking to invest across different sectors with a range of different technologies to really think about what type of future we will need in 2050 to reach a decarbonized economy, and what are the technologies that we need to be investing in now so that we can reach that end state. In terms of our pre-investment process, as I've mentioned already, the real importance for us is in terms of solution screening, thinking about what the greenhouse gas reduction potential of a company can be. We developed a called the CERC tool, which I'll speak about in a bit more detail shortly, but we use that as part of our screening process. And if you join any of our deal flow or pipeline meetings, you'll see that a question that is asked for almost every company that we speak about is, how do we believe that they will lead to a 2.5 gigaton reduction in greenhouse gas emissions? And how do we think about the impact of the company through its business model? So throughout the diligence process, we start off by thinking about having a clear articulation of the theory of change driving greenhouse gas reductions, and we'll build a model for greenhouse gas reduction capabilities, starting quite simply, but then developing and progressing in complexity as we think about how we think the company's success would lead towards climate mitigation. Invariably, we'll have a number of different scenarios as we think about this. We'll start with a base case, think about a conservative case, and add on a high case. and then also think about what we consider to be the key driving factors that we think will lead to the greenhouse gas mitigation impact. It's not a straightforward process by any means. And I think what's really quite important as we progress in our diligence process is there's always back and forth internal team review and debate on the greenhouse gas model. So as I mentioned before, it's something that is very much entrenched within our diligence activities, our investment activities, and all team members really participate in thinking about the greenhouse gas impact of a company, thinking about whether we believe the assumptions, the driving factors that we think will make an impact. And then finally, as we've made an investment, ESG reporting is part of the term sheet that we provide to companies. And within that is included greenhouse gas impact reporting in future years. In terms of portfolio stewardship, as I've mentioned already, I think helping portfolio companies, even before they become portfolio companies, with their greenhouse gas analysis is very much part and parcel of our focus. And we invariably help companies who apply to us for potential investment through the greenhouse gas analysis process. And we leverage a lot of the expertise and learning that we have acquired over the past years of performing this. We were pretty early in terms of the process of looking and thinking about quantifying greenhouse gas impact over many years already, and leverage that experience and expertise when discussing with companies. What we almost always find is companies have thought a little bit about greenhouse gas reduction capabilities, but many of them will not have thought through the various pathways, the opportunities, and how to think about what a realistic greenhouse gas target might be. So I think this is really helpful feedback that we provide to companies, that we receive also the input that it's really helpful, excuse me, as well for their future fundraising efforts, the sales, marketing, and recruiting efforts. So what may start off being something that they complete for investment purposes, for clean energy ventures, ends up being useful materials that they use in their presentations and hiring processes going forward. We're hands-on investors, as I mentioned already. We invariably lead deals. We'll take a board seat in a company as well, and we'll be proactive in helping our portfolio companies with market strategy, marketing efforts, recruiting, hiring, and fundraising in the future. And we have an extensive venture partner network as well, which we leverage to support our portfolio companies. And finally, as a point that I've mentioned briefly, but I think is really helpful to emphasize, is that we look to invest in companies where greenhouse gas emissions reduction is intrinsically connected to the business model and the success of a company. So as the company grows and its revenues increase and its number of customers increase, invariably the greenhouse gas impact of the company will also increase alongside it. I mentioned that we're one of the earlier companies and funds to think about greenhouse gas impact assessment as part of our diligence process. And this is something that we've been really quite keen to emphasize in terms of our industry and field building. We're keen to share our best practices, our experiences and learnings with the broader ecosystem. And that's part of the rationale of participating as well in this investor profile. But we think it's really important, as we all work towards climate change mitigation, to share what we're seeing and share what we're doing with others in this field. One of the tools that we've developed, the Simple Emissions Reduction Calculator, the CERT tool, is part of that process. It enables a company or investor to estimate the potential greenhouse gas savings of any company that they're looking at, or any process or service, from now until 2050, with just a very small number of key inputs. And this tool is publicly available. You can use it on our website without having to sign in or pay any kind of fee. And its use has been adopted by other climate funds, accelerators, and incubators. And it's something that we're quite proud of. I've mentioned already that we look to share our learnings and experiences. So I'm very happy to present our case study and answer any questions at the end of the presentation. And the other piece of industry and field building that we think about is really around the catalytic impact that we think that investing in early stage hard tech companies can have within the broader ecosystem. Great, so I'll dive into a quick case study of one of our recent portfolio companies. We invested in a company called Travertine Technologies just over a year ago, and they're working in the carbon to value space. I'll keep this simple, in part because we don't have a lot of time, but also in part because I'm not an electrochemist and the slides could get pretty complicated. But at a high level, the process that Travertine has developed is an electrochemical process that enables you to take in carbon dioxide, gypsum, and electricity, run it through an electrochemical reactor, and then to produce sulfuric acid, calcium carbonate, hydrogen, and oxygen. For the purposes of the analysis, I think the really important pieces to note here is first the initial capture of CO2 from the air, and then the eventual sequestration and storage of CO2 as a calcium carbonate, which is a stable form and can therefore permanently sequester CO2 from the atmosphere. And then the other component that's worth highlighting here is the production of sulfuric acid and hydrogen as a byproduct of this process. Invariably, the Travertine process is being used with waste materials as an input. But here you can see that you have valuable commodities like sulfuric acid, a widely traded commodity, and also hydrogen, which we know is an important part of the energy transition. So in terms of the process of running through our impact calculation, there were a number of different pathways that we wanted to examine, and I won't run through the calculations and look at the numbers in detail. What's important is that we'll just highlight the processes and the assumptions that went into our modeling approach. The first pathway is to look at the broader sulfuric acid market. So as I mentioned, one of the important byproducts of the process is to make sulfuric acid, H2SO4. And this is displacing an existing process where sulfuric acid is being made with sulfur or sulfur dioxide and producing sulfuric acid in that. As part of the current process, there is no capture of CO2. It's invariably an industrial process that is made in chemical plants around the world. But as you can see through the process that I laid out before, the flow sheet, you can capture CO2 as part of that chemical process. And you typically sequester half a ton of CO2 for every ton of sulfuric acid you create. So the analysis that we're conducting here is to consider the entire current sulfuric acid market, what the market share of sulfuric acid would be if Travertine's technology replaced existing processes, thinking about the annual growth rate for each of those pathways, and then how much carbon dioxide you would sequester as a result. As you can see, the way we think about it is to map out what we think the market penetration could be in 2024, in 2035, and then 2045, extrapolating that up to 2050, which is our target year. And then to consider in a base case, in a conservative case, and an aggressive high case, what the market share would be and what the subsequent carbon capture component would be. So that, I would say, it's a fairly straightforward calculation once you've run it through for each of the scenarios and each of the years. The second pathway that we looked at is for the phosphogypsum market. Phosphogypsum is a chemical waste product that is produced as part of fertilizer manufacturing, but it is a resource that can be also utilized. You can use it to create sulfuric acid, and then you can use that sulfuric acid again to extract phosphoric acid from calcium phosphorus. And so the benefit for the end user customer is that you can eliminate a waste stream of phosphogypsum. There are piles of phosphogypsum that are still strewn around the world. I think Florida has something like 1 billion tons of phosphogypsum waste product that's currently sitting, and it's mildly radioactive. So it's certainly a problematic waste product to have as part of the fertilizer production process. And so the way we thought about the phosphogypsum market is to say that Travertine's technology enables utilization of the existing phosphogypsum piles to make sulfuric acid. If their technology is able to unlock this use case and capability, what is the amount of additional sulfuric acid you would require to address these phosphogypsum piles? And what is the associated carbon sequestration that would be connected with that additional sulfuric acid use? So again, looking back at the sulfuric acid market and the capture of 0.5 tons of CO2 per ton of sulfuric acid produced. Again, we ran through the base, conservative, and aggressive high case scenarios. And just worth pointing out that we also thought about what's the maximum tonnage that we think would be processed within this process, within Travertine's technology. There's currently billions of tons of phosphogypsum around the world, but it's not to say that we consider that to be our entire addressable market. We capped out the max tonnage that would be processed per year in each of the base, conservative, and aggressive case scenarios. So in one case, 50 million tons per year, and another 25 million tons, and another 100 million tons, despite the fact that the addition for waste to this resource is increasing constantly. The third pathway that we considered was around enhanced weathering, and this is a technology that those working in the carbon to value or carbon sequestration space will have heard a lot about. Ore tailings from mining activities is an increasing source of what's called ultramafic ore tailings, and that is expected to increase as we continue to mine for additional minerals as part of the energy transition, especially around nickel and cobalt and copper. Currently, the ore tailings market is pretty significant. We think there's something in the order of 2.5 gigatons of ultramafic ore tailings that can be utilized per year. And these are naturally able to absorb carbon dioxide as part of the chemical compounds. However, the process of natural weathering, if you will, is pretty limited, and you can really enhance the ability for the ore tailings to absorb carbon dioxide by combining it with sulfuric acid. So again, using sulfuric acid as a feedstock into the process, we considered what the greenhouse gas and CO2 capture capabilities would be if we looked to start processing some of these ore mine tailings, and thinking about that in terms of, again, a base, conservative, and aggressive case scenario. Finally, we considered second order effects, and I think this is quite an interesting approach because it speaks to, firstly, the unconventional lithium resources that are available within the US. We often don't think about the lithium resources in the US, but there are resources available, but they are unconventional. So typically with the lithium bound in claystone, in a rock that will need to be dissolved in acid, again, sulfuric acid in this case, in order to access the lithium that exists in the mines. So thinking about what benefit could result from the fact that this unconventional mining process for lithium would enable is to think about what you could do with the lithium after. So one of the ways we've thought about second order effects is to say that if we unlocked additional capabilities of mining lithium within the US, what that additional lithium could be in terms of putting it into EVs, selling the EVs, and then the CO2 sequestration or avoidance from associated emissions from combustion engines as a result. So the calculation that we ran through is to say, if we could produce additional lithium using this process, how that unlocks greater deployment of EVs, and then to contribute only a partial degree of credit to Travertine's technology as a result. So in the bottom boxes, you'll see here, again, the base, conservative, and aggressive scenarios, but then also to think about only attributing a 2% credit to Travertine in this instance. So the calculation, therefore, is focused on the CO2 saved per EV deployed, but only 2% of that additional EV deployment credit accrues to our greenhouse gas calculations here. So to wrap up the process at a high level, as we've run through already, the way we build out our greenhouse gas and carbon mitigation modeling is to think about what our input data and key assumptions are. Around here, you have typical factors like the size of the market, annual growth rate, what we think market penetration can be for each of those different subsectors. Then you build the model and effectively create a model in Excel. That's pretty straightforward, but has a lot of complexity with a number of different variables. And then what we'll produce at the end of that is a summary for our discussion within our investment committee and our decision-making process, outlining the different scenarios, the expected greenhouse gas savings between now and 2050 in both the base, conservative, and aggressive case, and then to consider whether that will meet our 2.5 gigaton hurdle. What's an interesting point to consider in this particular case study is that when we initially made the investment, we were most excited about the enhanced weathering use case being part of the carbon capture and sequestration sector. And as the company has developed and spoken to customers, it's actually probably now the phosphogypsum use case that's probably the most compelling and presents the greatest opportunity for climate mitigation. So certainly, I think points to the fact that as we work with early stage technologies, we can certainly start off with a hypothesis for what we think will have highest impact, but that may not always accrue to what happens in reality. So just very quickly on lessons learned and next steps for us. In terms of lessons learned, I think I've shared already that we've analyzed the greenhouse gas reduction impact for many companies. What's really quite interesting is that a lot of companies may have really meaningful greenhouse gas impact and have important, valuable decarbonization contribution to our economy, but they may not have gigascale ton impact. And we certainly use this as a very strong screening criteria. We've turned down many companies that we think have exciting opportunities, very compelling business models and teams, but they don't have that gigaton impact, and therefore we don't evaluate them for investment. At the same time, we recognize the value that they bring, so we will frequently encourage other investors to support them. And I think another component that I think has been quite instrumental in how we think about this is the startups really require support in thinking through their greenhouse gas emissions and their reductions. I think that's really quite helpful and an important tool that I think important support I think we provide for the ecosystem. And then finally, I think it's always easy to map out the greenhouse gas impact potential for a company on paper or on a spreadsheet, but typically it's after we've made the investment that we really come to understand where the focus of the company can be for greenhouse gas mitigation. So I'll pause there quickly and happy to take questions. And I think Dave should also be on the line for any further questions.
Thank you so much, Eugene. Just a reminder, please, you can either put your questions in the chat or in the Q&A section. We really appreciate you presenting, Eugene. I feel like you can never really give someone a round of applause when we're virtual, but I will encourage people to just do a quick one, muted. So a couple of high-level questions that came in, and then I'll get into some that are in the Q&A. Could you just clarify that 2.5 gigatons, is it for your overall portfolio, or is it for a company when you're talking about screening and the company at scale?
Great, thanks for the question. It's for every company that we look at, so it's not across the portfolio. It's for each individual company we screen.
Fantastic. And then to your last point, unfortunately, there are plenty of companies that have high potential for impact, but maybe not at that scale. Are there any trends that you're seeing amongst the ones that perhaps you say no to, that you pass on to others, that you think are barriers to scaling to reach that 2.5 gigaton scale impact?
In terms of trends of the types of companies that we're seeing, or?
It does not clarify.
Sure.
So can folks hear me?
Welcome.
Yeah, hi Dave.
Hi, great to be here. So I'd say, so there's two factors when we're thinking about how you achieve that type of scale. Is what is the scale of the subsector you're impacting? So subsectors like concrete and steel, and obviously the energy sector have massive scale as a baseline. And so if you impact a relatively small percentage of that, and over time, you could still potentially receive billions of tons of emission reductions. Other sectors, aviation right now doesn't have as large an impact overall, and so you need a higher percentage. Or right now we're looking at data centers, and again, that's an area that's growing extremely rapidly. But right now it doesn't have a huge impact, so you need a higher percentage. So it's the product of the size of the sector you're impacting and the share of that sector that you're impacting. And a limitation is we don't believe that companies can achieve 100% market share. In fact, we don't often believe they can achieve anything close to 100% market share. And so when a sector isn't large enough that the company requires a very high market share in that subsector, we normally are quite skeptical about that and don't get to a conclusion that they're going to achieve it.
Thank you so much. We have a couple, it's very popular. Oh, here's a question. Do you adjust your baseline over time? So if you're looking into 2040 and 2050, does the baseline shift?
It's another great question. It's actually come up. So we've discussed this explicitly because when we started in 2017, companies had 33 years. Today in 2023, they only have 27 years. And unfortunately, that's actually reflective of the crisis that we're facing. And in my opinion, companies starting today and operating today actually do have more of a challenge and more of a burden than companies that started a few years ago. We have more of a crisis and less time to deal with it. So we have not adjusted the time frame. So yes, companies that we're evaluating today have 6 years less to achieve the goal than companies 6 years ago. But unfortunately, the world as a whole has 6 years less to achieve the goal than they had 6 years ago. So we're reflecting the crisis, the larger climate crisis, and what has to be done to address it.
Great, thank you. Do you invest in enabling, or what we call in Frame's methodology paper, facilitating technologies? And if so, how do you think about quantifying impact?
So I guess the way I'll address that, and I think Eugene covered some aspect of how we look at companies, and the way I phrase it is we look at two worlds at a high level when we're evaluating a company. In one world, the company never existed. In the other world, the company has been as successful, as feasible, and as the founders have hoped. And the question we're asking ourselves is, in that second world, are there 2.5 gigaton less emissions than in the first world? And what that opens up to our analysis is, as Eugene was talking about, second order, third order effects, right? So if the company is successful in proliferating a new technology that would not have existed without their invention, and it becomes so popular that, for example, it's copied in other parts of the world that might not have intellectual property protection, that would still count because that copying could not possibly have occurred without this company's invention. And so when we're talking about kind of the additionality question and, how it's impacting, if the emission reductions are happening through a chain of events that only could have happened because this company brought this new technology to the market that we're funding, then we do give credit for that chain of events.
Thank you. Here's a question that comes up at most of our meetings, but I think is a good one to answer. How do you account for any possible negative impacts? So do you deal with environmental impacts beyond CO2 in your screening process?
It's also a great question. So we are, first of all, bringing into our process net impacts. So often the companies that we're investing as a seed stage investor are pre-revenue. And so those companies, their own impacts, their own carbon footprint is negligible. But we do, of course, consider what their carbon footprint might be over time as they scale. And then, of course, we do consider, and this is part of our standard diligence, what negative impacts that there might be of the company. And so an area of a lot of discussion that we've had internally is, let's say, impact on fossil fuel industry. Let's say you're reducing the emission impact of enabling new fossil fuel production, let's say. And in the short term, you might be really reducing emissions. But if that results in a 2050 world that hasn't reached our carbon goals, then that really is, even if there are 2.5 gigaton of short-term reductions available, if this is impeding the world's climate goals for 2050, then it's a company we wouldn't invest in.
All right, thank you. And then investors, since you invest so early, what would you say would be your top 2 recommendations to help investors, help the companies track and articulate their impact?
So first of all, again, as Eugene mentioned, we do make the CERC tool available publicly. It's on our website, cleanenergyventures.com/CERC. And, we encourage others who are both investing or supporting entrepreneurs to utilize that tool. And so folks can do that initial screening for themselves. And let's really think about those 2 questions of, one, what are you doing that's reducing emissions at a unit level? And then how much of that are you going to be able to do? How much are you going to be able to scale over time? And think about how do you maximize those two values, and also, as per the last question, do this on a net positive basis without too much negative impact. But certainly, as you're designing a process, think about not only that unit impact, which is often easy to discern, but what's the scaling impact over time?
All right, thank you. Did you all have any last minute remarks before we give you one more virtual round of applause and transition to Morgan? All right.
No, that's great.
Thank you so much for being here. We really appreciate you taking the time, one, going through the profile, but also being very brave and presenting to our community here. I know we weren't able to get to all of the questions. Some I will go ahead and try to answer to the best of my abilities in the chat, or Eugene, Dave, if you're around, you can try to answer in the chat as well. The investor profile itself is more detailed than the presentation. We will be releasing that next week with the synopsis. So for those of you who had a few more questions, I would also highly recommend you take a look at the full profile. Real quick, we are going to transition to our next speaker, Morgan Scheel. She is AVP of Impact and Sustainability at Energy Impact Partners. Before joining EIP, she started her career in engineering and ESG in the oil and gas industry, and also worked in climate and sustainability at KR. She has done a lot of work in research and engineering, and has done a lot of work to advance not only forward-looking impact emissions assessment, but also inclusivity within our sphere. So thank you very much, Morgan. I'll hand it over to you and allow you to present.
Thanks, Carrie. Let me just pop my screen up and away we will go. Okay. The classic, can everyone see my screen?
Yes, you're good. Thank you.
Perfect. Hi, everyone. Excited to tell you all about impact and how we think about it at Energy Impact Partners. So kind of the agenda that I'm going to run through. First, for the overview. So we seek to invest in innovations that drive systemic change and accelerate the energy transition. So we invest in broadly two types of companies, and we think about impact in two ways. So that's directly measurable companies, which are similar to the companies we just heard about that have direct carbon emissions reduction, but then also what we call foundational, what others call facilitating, what some others call enabling companies. So companies that contribute to the energy transition, but in and of themselves may not be, or we can't quantify exactly how they are creating direct carbon emissions reduction. We run across multiple stages and work with companies of a large variety of maturities. So we operate in venture capital, private equity, and credit. Depending on the fund, some of our funds are much earlier stage. Many are growth investing, or what we call inflection, where the companies are commercial already, and then we also have a credit fund. Initially, we started out as an electricity and power fund. All of our founding investors were utilities. We have since expanded. So we invest quite broadly across electricity and power industry, transportation, built environment, food and agriculture, etc. We invest in North America and Europe currently. And then for impact assessment capacity, we have an in-house expert team of 4 currently, along with interns who are invaluable in the work they do. For size, we are 3.2 billion in AUM currently. And then we say 95% of assets assessed, just because our impact assessment criteria has evolved over time. And so some of our initial assessments, our initial investments didn't go through this exact assessment process. So impact goals and our process. So we really think it's important to integrate impact and sustainability throughout the entire, from end to end, from start to finish of what we do. And this looks differently depending on the team that in the funds that we're working with, but we do a lot of work with our different deal teams so that for deal sourcing and in diligence, we're working in lockstep with them. Impact is not something that is just tacked on at the end. And it's not something that we think should be like a nice to have. We think it's imperative. Just as you are investing and you need to build a financial model, we think you need to build an impact model, not only forward looking, but also to measure post investment, realize impact and how you're performing on that basis, especially if you're going to say you're investing for impact, which is something that we think is important. So pre-investment for deal sourcing, the three buckets are deal sourcing, due diligence, and deal documentation. So for deal sourcing, we work with our deal teams. For diligence, we generally will run that, working again with deal teams and with the prospective investments. And then for deal documentation, we think it's quite important that we work with a company so that we have access to the data we need to evaluate and work with them going forward. So part of that, our deal terms is a disclosure of data and working with us in our annual reporting process, which we think is quite important. What I'll say is what I think is even more important than the pre-investment work is the post-investment. So once we've made an investment, we're actively onboarding. So my team is meeting with every portfolio company. We're going through our process, our expectations, really working with them on that. We want to make sure that we prioritize high quality impact measurement, and it's not possible, frankly, to do that without being in partnership with the portfolio companies. Frankly, we also find that it's adding a lot of value to them. So it's really a win-win for both of us. And so we use kind of this active ownership to really start generating that value. We've done an impact report reported publicly the last 5 years. So our fifth report was just published recently, and you can find that on our website. We think it's really key. We had over 80% participation from the companies in our portfolio, and I think we have over 80 active investments. So it's quite a bit of work that we put into it, and we think it's pretty important. And we also think transparency is quite important. Lastly, we have been thinking through exits and what this means in terms of exit, both for our companies and then also as we think through what going public for some of these companies might mean. We are a later stage investor than many climate investors in this space. And so we want to make sure we're being thoughtful and setting our companies up for success, not just while we're actively owning them, but also thinking through what that means in the future, as presumably some of them will be going public or being acquired by larger public companies. Okay, so pre-investment, so deal sourcing. So we have an ESG policy and exclusion list that we use, an exclusion list that prohibits investments in certain sectors. So including fossil fuels, which is part of every assessment. We think that's pretty key. Now, this is somewhat less straightforward than you may think, because there are technologies that we're looking at to invest in that may have alternative uses. So some geothermal technologies may have alternative uses for mining or other purposes like that. So it's quite important for us to run that assessment and make sure we're not investing in a technology that could be used for purposes, or it could be repurposed in ways that we don't want to perpetuate. Our deal teams, we've done a lot of work with them, a lot of training. So generally for deal sourcing, we expect the deal teams to do a lot of that initial impact assessment. There's 4 main themes with which we invest in the energy space. So decarbonized supply, sustainable demand, and intelligent infrastructure, and foundational technologies. Again, foundational technologies are where we have solutions that in and of themselves may not be directly reducing carbon, but we think are really important for the energy transition. So carbon accounting is a really good example. We think it's really imperative that companies be able to understand what their carbon footprints are, what their scope 1, scope 2, and particular scope 3, which is quite difficult to measure what those are. But a company doing that work and doing that measurement in and of itself is not reducing or creating any emissions reductions, because they wouldn't have a direct ownership of any changes that are wrought. And so we think that those kinds of companies are important to fund and to enable, while recognizing that there's not a direct impact that they're going to have. We do look at their impact more broadly beyond just carbon. Then in due diligence, we have 3 components of our impact and ESG diligence process. So first is carbon impact measurement. We do a planned impact assessment. It's a bespoke model that we develop over 5 years where direct impact is identified. So that's for directly measurable companies. We do not measure all the way out to 2050 or 2030. So I guess we're getting relatively close to 2030 in a 5-year assessment, mainly because our stance at EIP is that we think we do not understand enough what the baseline scenario or the status quo world will look like. And so in the absence of that confidence, we think it's too uncertain for us to understand what the comparative is going to be to these technologies. So we try to keep it, we generally don't model over 5 years. And we try to focus more on the shorter term, more immediate modeling, where we think we have more confidence in understanding what that delta is going to be. We also assess environmental factors. So we assess environmental practices, policies, look at risks and opportunities for these companies. So we think it's really important that if there's amazing carbon impact, but then there's quite negative environmental impacts elsewhere, we don't want that to get lost or potentially invest in a company that could have quite terrible water implications or pollution implications. So we think that through as well. We develop, and then the last one is social and governance factors. So we assess diversity, equity, and inclusion. We think that's very important. So we assess that for every company. We also look at other aspects of social aspects in the company. So what kind of policies do they have around different things? What are the risks and opportunities? And then we also take all of this and we view this through a lens of context and maturity. So we think this is really important because we invest across asset classes. We don't have like a single benchmark, or it's not a binary 0 or 1 that needs to be met for carbon to be, or for impact and ESG diligence to be give the thumbs up or thumbs down. That's not kind of how we think about it. For an early stage industrial deal where the company is Series A, we would look at the diligence and the scoring across these factors quite differently than we would. Sorry, can you guys still hear me?
Yes, we can still hear you okay.
Okay, good. Apologies, my headset cut out for a second. Then we would for a later stage software company. Maturity and industry, it's just quite different. So how we would think about our expectations around diversity would be different. If an industry itself is not a particularly diverse space, we don't want to be holding a company to unreasonable expectations of 50% if the industry itself may only have be 20 or 30% women. So we just want to make sure we're assessing companies to appropriate benchmarks and expectations. And we view this also as a starting point. So we are quite active in our stewardship and in the work we do with companies. And so the way in which we evaluate and score companies across these, we update this annually, and we view this as like the starting point of their journeys. So we want them to improve over time, and we want to work with them to enable that improvement. So post-investment, so active ownership. So this is where a lot of our work comes in. We're very active owners. We immediately will start setting up portfolio onboarding conversations and getting to know the portfolio companies. This ranges. Sometimes we're working directly with the CEOs, especially for earlier stage companies. Sometimes there's someone who is their entire job is around reporting and measurement, which is always really amazing, and we're getting into the nitty-gritty details with them. But we want to make sure that our expectations are clear, how we go about measurement is clear, and that we're giving them the tools for success. So it's as easy as possible. They're getting us the data we need, and it's not a confusing or difficult or onerous process. So we tailor that engagement for every single company. We also just this year kicked off a collaboration with our co-investors. So we realized historically in the past, we were one of the only investors who were asking portfolio companies for reporting and for this work, for this data. In the last, I'd say, 1 to 2 years, there's been a proliferation, which is on one hand amazing that people care and they're asking for this information, and it's become much more central. But on the other hand, it's become much more onerous for portfolio companies. And it doesn't really matter how thoughtful we are in trying to boil our questionnaire, boil our data ask down as much as we can if they're getting 5, 6 different investors coming to them, all with slightly different asks and with slightly different requirements and definitions. So something we've started doing this year is in our onboarding, going to them being like, have you received any other data asks from any other investors? Getting connected to them, to the people who are asking, and then working without the company so that we can streamline that ask. So often that means we compare what we're asking for, our requests, and we consolidate it down, we standardize. We've been working pretty hard on that because we think it's really important to make this easy for the portfolio companies. And we're hoping in the future this will be done by an external organization and will require a lot less effort from us to do because it's quite a lot. But yeah, so in addition to that, we think if we're having expectations on what good practice is, we want to give the tools to portfolio companies on that. So we're developing what we call toolkits and resources on different topics. So the first one we did was diversity, equity, and inclusion, and it ended up being over 50 pages on many different topics available to our portfolio companies because we think it's really important. And we also recognize that it's not an area where a lot of startup founders or their founding teams have expertise. And so we want to try to set them up for success versus having them being very well-meaning and wanting to make improvements, but not really knowing where to start. So beyond our active engagement, we do a ton of impact measurement and reporting. So we do realized impact measurement. That's actually the majority of our impact measurement. Now, what does that mean? Realized impact measurement is backward looking, not forward looking, and it's looking at what impact was actually achieved over the past year, or at least for us, we look at it over an annual time frame. So we call it annual enabled savings. So we've been doing this for the last 5 years, as you can see. For our annual enabled savings, in this most recent year in 2022, we had 11.3 million metric tons of CO2e achieved, which is up from 6.4 the year before. So we were quite happy with that. We also do lifetime enabled savings. So lifetime enabled savings are the lifetime savings of our technology that is deployed over their entire life cycle. So we recognize if we're only looking at 2022 and the technology has a 10-year lifespan, that's the small fraction of what it will achieve over time. And so we try to assess what has been locked in terms of savings, in terms of actual units deployed, operating in the field. So whether that's a battery, whether that's a thermostat, whether that's a solar panel, what is locked in and deployed and operating. So that does not include any kind of growth of the company or growth of the market or the sphere. Lastly, for companies that are earlier stage that are pre-commercial, we do projected 5-year enabled savings, or what Project Frame calls planned impact, where we're looking 5 years post market entry. So we set market entry as 0, and then we look 5 years post that and measure the impact there. We saw a lot of growth this year. Another big thing that we do is we last year invented ownership, what we call ownership weighted savings. And so we think we aim to be as conservative and as transparent as possible. And we recognize that we were saying this is the total annual enabled savings, but we don't entirely own all of these companies. And so we thought it was really important that we capture how much we think we can own based on our ownership. Now, we also think there's a good reason you can make that we contribute to a lot more impact and a lot more savings than just our financial ownership, but we haven't yet figured out a better way to capture that. So in the absence of a better metric, this is what we're using. So we did that for the first time last year in 2021 for last year's data, or for 2021 and last year in 2022. We didn't do that retrospectively, which is why we only have it for the last 2 years. But you can see our impact is growing significantly year on year, any way you cut and then slice this. Yeah. So another way we want to think about realized impact management is we want to ensure that our enabled carbon savings are far greater than our footprint or the emissions that result from our operation. We think this is an important comparison. Now, these don't cancel out, but we wanted to capture kind of visually how much greater our savings are compared to our footprint. So even if you take the smallest, most conservative measurement, which is our annual ownership weighted enabled savings, which is not small, but compared to 11.3 million metric tons, when you compare that to our internal footprint, it's clearly much larger. Our internal footprint is our scope 1, our scope 2, and our scope 3 minus financed emissions. So that includes our company travel, commuting, goods, everything except for financed emissions. And then our total footprint includes that financed emissions, which is the emissions from our portfolio companies, which we assess as part of our impact measurement work across scope 1, 2, and 3. So whether you take our internal footprint or you take our total footprint and our financed emissions, you can clearly see that the impact we're enabling is much, much larger.
Morgan, I'm going to give you like 3 more minutes.
Oh no, okay, I'll go faster.
Maybe up to 5. Thank you.
Okay, thanks, Carrie. We also think creating an ecosystem is really important between portfolio companies and between our partners, our LPs. So commercialization and research are the main areas in which we do this. We think impact is central to that, especially as many of our LPs are corporates who are looking to decarbonize. Realistically, when you look at the energy transition, what's really imperative is that existing companies decarbonize and that they take on new technologies and change how they're currently operating, not just new companies coming into existence. We have to transition existing companies and economies as well. And so we really work to be partners there and to connect our corporate investors and corporate strategic companies to our portfolio companies. So by the end of 2022, we had almost 2 billion in cumulative bookings between those two groups, which we're very proud of. And then we also do knowledge building. So we did 16 working groups in 2022. I myself ran 2 different working groups for our partners, our LPs, on impact and ESG. In these working groups, we bring in our portfolio companies and also portfolio companies in the ecosystem to present to our LPs, who are looking to then often find opportunities for solutions that they need in their businesses. And so they are working to collaborate together. And so we help them understand what the landscape looks like in different areas, from heating and cooling to commercial buildings, cybersecurity, supplier diversity, et cetera. And then we also help the portfolio companies get live feedback from corporates who are often quite difficult to deploy into, which we think is really key. So case study, I'll speak about this briefly. So Form Energy is one of our portfolio companies. They officially launched partnerships with 2 different EIP coalition partners, so Georgia Power Company, which is under Southern Company, and Xcel Energy. Their battery storage systems are going to allow utilities to integrate more low-cost renewable energy into their systems, which really helps solve for renewable intermittency problems. Impact is really central here. These companies have both made commitments to be net zero or to have 100% carbon-free electricity by 2050, with interim targets along the way in 2030 and 2040. And so they are really looking for opportunities where they can know what's going to decarbonize their power systems and decarbonize their operations as achieving those goals. So impact is central to them making deals and building partnerships with companies. Lastly, lessons learned and what's next. So we think standardization is really key. We think that's kind of the next hurdle. And what we've seen, it's great that there's a lot more interest and its measurement has been expanding, but we think we need to standardize. And we're not alone in thinking that, thank God, which is why we're part of groups like Project Frame, which is doing an amazing work. And I have to give Carrie and the whole team a lot of kudos for that. We also think transparency is really imperative. We see that there are organizations who report impact numbers or make claims, and then they don't actually give you any information behind that. Our newest impact report was, I think, almost 120 pages. And we also put out a technical appendix, and we go through the methodology behind the impact measurement for every single company. And so we think that's really key. because we don't think there is one way to standardize impact measurement. It's kind of like there's no one way to build a financial model, but we do think that there are guidelines and expectations around what a good financial model looks like, just like there should be for what impact reporting looks like. What we also are seeing is that a lot of climate investors start with early stage companies. A lot of those companies are shifting from the theoretical to reality. And so they were pre-commercial when the investment happened, but a lot of them are now entering markets. They have real products, boots on the ground. And we think that impact measurement also is going to need to shift to capture realized impact, not just theoretical. So once a company is in boots on the ground, commercial, has units that are deployed, we stop doing a planned impact measurement and we shift to realized impact because we think it's important to measure. I mean, in diligence, we're still doing the forward looking because that's part of our diligence process, but post investment, we shift. And lastly, impact measurement is an area of value creation, and we think it needs to be supported and resourced as such. Okay, that's it for me.
Thank you so much, Morgan. We really appreciate it. Virtual round of applause from everyone, please. So real quick, we just want to remind everyone that they can either use the raise hand function or use the chat. Question that came in early, Morgan, since you were talking about how since you were talking about realized impact, how has looking at realized impact shifted your practices around looking at planned and potential?
Yeah, I mean, I think it helps us be even more conservative. So I think it's quite humbling when you have these larger numbers. It's quite exciting when you're building these models to think about how they're going to change the world and impact the world writ broad. But then once you shift from the theoretical and you start looking at, okay, what was deployed, what's the unit carbon impact for that, what units are actually operating, the numbers get much smaller. And so I think that helps provide us a check and helps us think through, okay, what is actually realistic, and helps us collect data on what's realistic from a scaling perspective, because I think that's one of the most difficult things to get right about impact measurement. And so by shifting to realized and doing that backward looking assessment, it has really helped us refine our scaling and for our forward looking assessment.
All right, great. And then you mentioned toolkits. What would you say are the toolkits that you're most excited about to help your companies? And then are any of the toolkits available?
So right now we're only making them available to our portfolio companies, which I hope in the future they will be publicly available, but we're early stages in this work. So we're trying to collect information first. A toolkit that I'm excited about, we want to create them around like suppliers. So we're trying to develop the toolkits where we're getting questions from the portfolio companies. So some areas are around suppliers. So our portfolio companies want to understand how they should be assessing their suppliers because they're getting questions about them and they don't necessarily know how to approach that. Another area is, how do I build, like, what are best practices around LCA development? I know I have to do this. How do I make sure that this is meeting best practices? Or how do I become a B Corp? What does that look like? Can you help me? Some of these are going to be very short. It's just going to be resources pulled together. Some of them are much, much longer and more detailed, kind of tailored to the act. But I'm excited about all of them. It's very exciting to work with the portfolio companies.
Great, thank you. And I hope we'll continue to share those lessons learned as part of Project Frame as well. Do you see any correlation between proactive carbon or sustainability management and portfolio companies and exit valuations?
I don't think we have enough data yet to do that assessment, to be honest. We have a lot of active investments and we have a good number of exits, but we don't have a statistically significant number or even a large enough number to like really do that analysis in a rigorous way. And what I will also say is the companies that are exiting, many of which predated some of our more active engagement around carbon and impact. So it's kind of not an apples to apples comparison for all of them right now.
All right, thank you. In the interest of time, I'm going to put another question we got from the Q&A in the chat for you, and then hopefully you can answer it directly while I go through sort of our closing. That works. Here you go. Thank you so much. And once again, we will have the full investor profile on our website, as well as a synopsis coming up in the next 1 to 2 weeks. So if anybody would like additional information or contacts, I definitely recommend reading the full investor profile. If you're interested in doing your own investor profile, please let us know. As I mentioned earlier, some investors like to go through this process just as part of their learning journey or to work with their impact teams. You are not forced to publish it or to do a presentation. We welcome you if you would like to publish it and share it with others, but not everyone will be given a public webinar. If you're interested, please send us an email and we're happy to send you the form to fill out that you can work through. And then if you decide you do want to go through the process and get it published, there's typically a couple of rounds of interviews to refine, and then we help you with the graphic design and publishing the materials. As we said, we are in the process of updating the questionnaire based on the feedback we got today, or up to date. Thank you to our 2 guinea pigs, Clean Energy Ventures and Energy Impact Partners, for being our very brave firsts as far as working through this together and being willing to share publicly. And so we hope to finalize the 2.0 version sometime next month. And then, of course, there will be future iterations in next year based on the feedback we get, and hopefully as the community continues to evolve. All right, I just wanted to give everyone a quick update on what's next. As a reminder, we just launched our LinkedIn page yesterday, so please keep an eye out for that and be sure to follow us. Our partner, or another organization that we follow closely, is Bluemark, and they just issued a report on the landscape of IM that also includes climate investing. We're including that in the chat and encourage others to read it. We have the tool showcase synopsis from our data and tools working group coming out soon. And then we do have an upcoming blog to complement the methodology guidance on questions LPs should ask. And then we hope to host a small group discussion with Asia investors in July as well. Might be a little bit later in the year, but we're aspirationally hoping for July. So if you know any Asia-based investors that would like to discuss some of the challenges of assessing forward-looking emissions impact in their market and how it might also tie to adaptation, that we think that will likely be the topic of the small group discussion, please contact us if anyone who you think would be interested in participating. And mark your calendars. Our next community meeting will be August 3rd. So we typically host these bi-monthly, and we look forward to seeing you then. I thank you all for your time and wish you all a great rest of your day and a safe and happy weekend.